welcome to another edition of the Energy Podcast. Ryan Ray alongside Dr. Energy herself and Wald. Ellen, how is it going despite the Giants? I feel bad. I called them RIP Giants, and then I said they've resurrected, and now they have died once again. It feels like
Daniel Jones is not ready to be an NFL quarterback. That's basically the story.
That's the analysis in a nutshell. I like it. Okay. Well, we have a lot to get to today. Dr. Dean Foreman will be joining us here in a little bit, so let's get into it. Ellen, let's turn first to the Wall Street Journal. Oil prices set to climb. Investors aren't betting on it. And the subtitle is Softening Demand and Strong Production Have Soured Investors' Outlook on Crude. Now, we have a listener to this show, and I talk about him on the Texas Oil and Gas Podcast, regular named Speakner, and he kind of is big on the Armageddon that's coming to the oil and gas industry, where a lot of the small cap, mid cap companies will go out of business and will be picked up by larger companies. However, we covered a story this morning on the Texas Oil and Gas Podcast talking about how the spare pipeline capacity issue, where in the Permian it was, these pipelines were chock full of oil for so long, and now they actually have spare capacity, which means that producers can sell, they can make more money on their on the price of the oil they put in the pipeline. So while they are cutting their capital expenditures, they actually can make more money on the product they're selling in the pipeline. So it really is kind of a best of both worlds. And so I thought, that was an interesting take on that outside of where the prices may go, that there are other market indicators that maybe the investors are overreacting here to what's going on in the market space.
That would not surprise me that, the quote unquote investors who are clearly, they're talking about like banks and, those guys don't have a handle or don't really get that aspect. I talk to these people, they're great, they're smart, they're nice, but I don't think that that some of them are really down and like into what's really going on in the Permian, like a few, but most of them are just looking at this big picture and they're probably saying, well, demand is not so great, so therefore oil prices are going to go up, and they're not actually looking at the kinds of things that you guys are seeing on the ground and looking at, hey, look, there's all these other ways that these companies can make money, and and not seeing that. So it wouldn't surprise me that they're not seeing it.
Yeah, and I think when you talk about these issues, we talked about this on the show before, you just can't take one story and say this is how it will work for all companies. There's too many companies.
Next week the Wall Street Journal is going to run a story saying oil prices are heading up. Investors are betting on $80 oil by Q2 2020 and so. I bet that'll be the story next.
It will be in some publication for sure. If not, 20, and you'll see the story about $200 headline. I haven't seen the $200 oil headline in a while, so it's got to be out there. It's got to be coming. Someone's got
100 is the new 200.
No, 100 is the new 200. Okay, well, yeah. And so I heard someone the other day talking about this, and they're kind of just going back into history, and they're saying, everyone is mad at these shale producers because they're not making money, but it was Wall Street who told them, don't make money, go expand your drilling programs. Like, go do this, and we'll give the CEO a huge bonus. And so they incentivized them to do that. And now they said, well, now you have to make money. And it doesn't mean that most or, maybe a good portion of them will not make it, but it's more because of, I say more because part of that reason is because of how they were incentivized to make money historically, whereas now they're not incentivized to make money that way, so they have to shift their focus. And I always use the analogy, you're a teacher, so maybe this will work with you, but I always use the analogy of school grades. If you have an F in your test or in your midterm, you might not pass the class because that could bring you down so low. And so some of these companies who had some bad years, they might not make it, but they are trying to pass all the quizzes, do all the little homework assignments, participation, whatever grades you're giving out. They're trying to hit all those check marks now. And so, but still that one or two Fs in the middle of the year might sink you.
Yeah, that's a really good analogy. I actually was reading, and I don't have a link to this for our listeners, unfortunately, because I was actually reading it in old school news press. I'm going to hold up a copy at Barron's as I
Wow,
pulled
they
it
make
out of the
those
paper.
still.
I know,
Wow.
and they deliver it to my door on Sundays.
Oh, wow.
Usually. Sometimes
Usually.
they just don't. I haven't quite figured out the rhyme or reason to the days that I don't get Barron's, but sometimes I get Barron's. So I was reading this. It's called An Energy Stock Worth Drilling Into, and it's basically about ConocoPhillips. And this maybe kind of plays. I know ConocoPhillips is not one of those. They're certainly not one of those small-time drillers, but it's interesting. And they're talking about, so the company has 5 priorities right now: sustain output and pay the current dividend, increase the dividend, maintain an A credit rating, pay out more than 30% of annual cash flow from operations, and be disciplined in investments to increase cash flow. That sounds an awful lot to me like they're trying to prioritize making money for their shareholders and not necessarily expanding production. So that kind of fits with what you're saying.
Yeah. And so, but... So
or at least raise their share price. It definitely looks like they're trying to raise their share price.
Right. And so you say you talk to these people. So here's my question, I guess, is if we say that historically investors, Wall Street, they pushed these companies to expand the drilling program, not worry about dividends. Now they are saying we want our money back. You need to rebalance your books so we can make money. My question is there any forethought from the investor standpoint on future price of oil? So think about this. If you're thinking that the price of oil is going to be stagnant at 55, we'll say WTI, 55 WTI for a couple of years, then you're saying, okay, hey, we want the companies to be profitable at 55. Of course, if the price goes up to 70, theoretically, you should be more profitable. But is this a sign from Wall Street that's saying that, hey, we think that prices are going to be soft. I'm using the term soft at 55 for a while, and so therefore you have to be able to hit these numbers, or is it because they kind of taken a beating for so many years they really don't care where the price is at? They're just like, hey, you have to make money at this point. Because I was going to say, if they do balance the books and the price does go up, then you do actually have a kind of the best of all worlds because the price went up, the valuation goes up, and you make back some of that money that you bet on these guys.
My gut tells me that it's a right now kind of thing, and that they're interested in returns for next quarter and maybe a couple quarters down the line, but that I think that they say that they, they're like, oh, well, we're doing our calculations based on, max price of $60 for oil for the next, 10 years. Look, we all know that that's not going to hold out. I mean, the only thing we know for sure is that the price of oil will not be what they think it is going to be. It will be something else. So I think that they might say that they are, but I think they really are just looking at the near term.
Yeah. Yeah, and that is one of the problems with the way that public companies are ran is that there's such a very short window on it that it can skew where the emphasis is and where it needs to be. So now I was you have something?
No, go ahead.
No, okay. I was pleased to see this article make its way into this. It felt like last year we really had a lot of Tesla content. This year, not so much, and it's been disappointing. Ellen has stepped her game back up. She's back on it. This is from MarketWatch. Tesla speeds towards unpleasant earnings turn. Boeing faces tough questions. Now, if you want to talk about headlines that shouldn't surprise you, is it that one of them?
Yeah, exactly. It's interesting. So they think that Tesla is likely to see year-over-year revenue decline in its first quarter and its third consecutive unprofitable quarter, despite selling a record number of cars.
Hold on. That is a slightly misleading because it's its third consecutive unprofitable quarter, but that would mean that they had three profitable quarters out of 10 years, though.
Yeah, exactly.
Right? So,
yeah.
I mean, when you
they had every quarter was unprofitable, and then one quarter they made a profit, and then they went back to making no profit.
That's what I'm saying. It's like when you write that way, it's like, oh, they've only had 3 unprofitable quarters. Well, actually, over 10 years they've had 3 profitable quarters. So this is the norm, not the exception.
Here's what it says then. It says investors will be looking for positive free cash flow, a forecast for profit, or any signs that Tesla is on a path to profitability, or wait, it gets worse, or at least the demand is still strong for Tesla's cars. So first they want positive free cash flow. Then they'd like to think that someone at least has a forecast for some profit for Tesla, or maybe a sign that in the future they could be on the way to profitability, or, well, at least we'll take that demand is still going for Tesla's cars. I mean,
Right. God.
Maybe they should be like, Elon Musk is laying off the pot, and that's a good sign. Like, let's cut our expectations to the absolute lowest possible.
What's interesting is this in the major portion of the piece, but it does talk about Boeing, and we haven't. We had on, if you remember when the 737 MAX was grounded, we kind of talked to Dr. Foreman about that. And you would think right now, with fuel prices being relatively low, that airfare would be cheaper, it'd be more affordable, air fuel would be more affordable, and that it'd be a good time to be in the airline business. But it doesn't seem to be that the 737 MAX at least is having some impact on there, because it says they dropped 40% in profit and 22% in sales. And so, I mean, it would just seem to be a good time to be in the airline business, all things considered. But
I think the only time that was a good time to be in the airline business was before September 11th. I mean, well before, not like up and I don't think that the airline business has done particularly well since then. Although there was one point where they made massive amounts of profit, but everybody hated them. Like, it was so bad.
They are a despised industry. Like, there was an article in Bloomberg the other day that was talking about they're going to get rid of some of those in-seat monitors and the various things. I don't know if you saw it or not. And they said, and the article theorized that if they did all that stuff, they'd pass the savings on to the customer. And I thought, no way. Like, no way am I going to save $50 on a flight because they removed the in-seat monitor. They're going to charge me the same, may charge me more because they had to renovate the thing, and then not do the in-seat monitor. So I thought that was and
they're going to charge you to per video you want to watch or something.
Oh man, it's
and then they're going to then they're going to what is it that they're constantly doing? They're gonna put more seats in your plane and all that. We can get rid of the monitors, therefore we can make the seats closer together. It is interesting though. Speaking of planes, so apparently a Qantas flight, they did the first it was like a 20-hour flight from JFK to Brisbane, and they had all these researchers on board. Here's the thing: it could be safe to take a 20-hour flight, but could you from a just emotional mental I don't think I could handle it. These airplanes are so uncomfortable.
So I've flown 17 hours. That's my limit. That was So when you fly from Johannesburg to Atlanta, it's anywhere from 15 and a half to 16:45 nonstop. It depends on when. So 15 and a half to 17 hours usually is kind of where that flight's at. When I read that piece, I thought this is one of the most useless pieces ever, because you're talking about first class. Put us back there in economy where you're stacked in like sardines, and then tell me how, because they had those stretching exercises. I'm like, you ain't doing that in economy. You're stuck in there for 19 hours, 20 hours straight. So I read it. I just laughed. I thought this might be the most, when people talk about being anti-elitist, this is probably the most elitist. Can the people in business class survive it? Not the schmucks in the economy who are, don't have all of the special foods and all this stuff. So I got a chuckle out of the fact that they were judging it from the business class perspective, not shoving 250 people in the back of the plane going, hey, can you suffer? And for the record, I do not want to try that flight.
Maybe they can put us in cryostasis or something.
We're gonna have to get that.
20 hours.
We're gonna have to get to that point because something that's and I don't know. Is there a big demand to go nonstop service from Sydney to New York?
Yeah, I don't know. I can't. That's the thing. I don't even think I'd want to. It'd have to be so incredibly cheap for me to consider doing that flight. I think the longest I flew from Chicago to Abu Dhabi. That was a long flight. That was 12 or 13 hours, I think. And that was long.
So the reason I go Atlanta to Johannesburg is just because it's nonstop. So I can fly. When I used to live in Louisiana, it was an hour to Atlanta. Here it's an hour to Atlanta, and then I fly to Johannesburg, and so I'm there instead of having to fly to London or somewhere, wait 10 hours, and so you add 20, 30 hours travel time round trip. So from that standpoint, it is worth it for me at least. But yeah, when you're talking about 19, 20 hours, especially if you're flying coach, I mean that's brutal. Okay. Speaking of things that are brutal, let's talk about the Aramco IPO. And so Nate will be linking to we had a discussion about this on the podcast this morning, and so we will be linking to that for the Texas Oil and Gas podcast, our old discussion, and Nate might as well link to that as well on these show notes. We discussed this a couple weeks ago, but it's a never-ending story. And the last time we discussed it, my theory was that they're not going through with it. Your theory is that they are going through with it. I theorized if they are going through with it, it meant that prices are going higher. You theorized they're going through with it, regardless. That's kind of where things were.
Yeah.
2 weeks ago.
And now we get another delay. So this article doesn't really talk about the delay.
It doesn't talk about the delay at all, yeah.
No, because so it's funny because I gave a quote for this article on Wednesday morning. Mm-hmm. And it was a very positive quote. It's funny because the quote that they took for me, there was another sentence actually after that, the quote that they took that was I said, listing first on the Riyadh exchange is a great opportunity for Aramco to access first the type of investors that might be the most excited about the public offering. Between the domestic Saudi enthusiasm for the company and government encouragement of investment in Aramco, Tadawul is bound to give Aramco the best opportunity for a high valuation. And then there was another sentence after that started with however, as in here are the downsides, but they didn't choose to print that, which is completely within their, journalistic rights or whatever they're called. But it's interesting because kind of what I was hinting at is they can do this Tadawul thing first because they can basically convince people or persuade them or pressure them to buy in. And I think that the reason that they see it as a way to get the valuation that they want because that'll get them the most money. But now, and I should have linked to, I'll link to this article I wrote on Forbes on Friday after we got the news. The news came Thursday afternoon that they were delaying again. And everyone's got a different reason about why they're delaying. And I think that none of those reasons are totally correct because, and I'll link to this in the show notes. I can't believe I didn't put this piece in, but basically I think that the Saudis didn't get the valuation that they wanted from the banks. I think that banks probably came with a valuation of 1.2 trillion and the Saudis nah, we'll wait.
Yeah.
Because here's I think I'm not saying that this is the right thing to do either for the Saudi economy or for the IPO or in the long term. I'm not saying that this is the right thing. And we all know, I criticized their plans, from here to the halfway last week on the podcast. But I do think that if their goal is to get this 2 trillion or get as close to it as they can, that delaying was a good idea because they're now basically into a negotiation with these banks. And they're basically saying, all right, you don't want to value it high enough, then fine, we'll wait. So, and these banks may stop to drop out, and it would actually be a good thing if they let some of the banks drop out. They've got a bazillion banks doing this. They don't need 25 banks on this. Let some of them drop out, and then see if the other ones come around.
So one of the things I'm curious here because I'm not an IPO expert is I'm assuming when they get the valuation, Aramco can look at it and say, okay, the bank is saying basically we're producing this much oil at this price. I'm very much simplifying. But
I think it's more here's what we think we can get for the shares. I mean, I'm sure they will display some sort of complicated, theory or theorem or whatever. But really, in the end, it's the banks have to buy all the shares from the company. Right. So the banks are going to lay out cash for this, and that's what the government is getting. Then the banks are going to sell the shares in the market. So the banks have to then worry, okay, right, are people going to buy shares at this price that we've determined? And if they won't, then the banks are stuck with shares that they haven't sold.
Right.
So the banks want a lower valuation, but the Saudis want a higher valuation because they get their cut when the banks buy the shares from them.
Right.
So, so you can see why the Saudis want the higher valuation initially. And, you don't want the shares to fall, but like that's not going to necessarily affect how much money the Saudis get immediately.
But I guess what I'm saying is that the Saudis should be able to have enough information to figure out. Let's say they want $2 trillion or whatever it is, $3 trillion. They should be able to do the math on production number, price equals a higher valuation. And so, could it be that they're just trying to time the market and say, okay, well, it could be a bidding war like you're saying, but also, is it possible they're saying, well, now that we see what the banks are valuing all this stuff at, if we change these factors, we can actually get the valuation we want to be at.
That's possible. Like I said, that would also be really logical.
And again, Mr. Logical.
Yeah, I'm accusing you of logic.
I'm sorry.
Yeah.
Please.
That would be super
logical.
So they'll say like, okay, so how about next quarter we just produce more oil?
Right. Or whatever.
Right, which isn't quite so simple, but because they're in OPEC and all that jazz. But yeah, they could totally be saying that, and they claim, okay, the stories they're waiting to see the third quarter earnings. But here's the thing: why would you ever want to wait for this particular third quarter earnings? You're gonna have your lowest production numbers in a long time this quarter because of those attacks. So I'm not sure what they're like. That's why I think it's a battle of the wills between Saudi Arabia, the government, and the banks. It's this battle of the wills and who will come out. Personally, though, I think they need it for the FII because otherwise it's going to be a total bust. It's their big investment conference. Okay. Total bust without a Aramco IPO.
I'm still in they're not going to do it camp.
And you could be right.
Like I said this morning, I said Nate's going to link to this. This is my position, but listen to Ellen, she's the expert. So
I'm not. It's like I said. I mean, I'm like in the. I think it's like a 60-40. 60-40 yes to no. So
I'm going all in because I have nothing to lose. I'm not considered an expert on it, so if I'm wrong, they're like, that guy didn't know he's talking about anyway, so I can just go all in on it. And then if I'm right, I sound like a genius. I'm like, I told you guys. I told y'all. Now, of course, they could theoretically go at some point in the future, but any point in the future. But anyway,
do you think people are betting on this in Vegas? Like, is there an over-under on, like, the Aramco IPO?
There's probably not well, I mean, maybe, but there's definitely, I guarantee you, there are certain financial institutions who are betting on it in the way that they're investing in stuff.
Oh, yeah.
And so.
But I was just curious, like, if there's, like, a line in Vegas.
God, if there's a line in Vegas. Yeah. Let's see if Nate can look that up for us by doing this. If there's a line in Vegas, I will go with whatever that line is because Vegas, them dudes got the inside tips. So, a couple more quick stories before Dr. Foreman comes on. Let's go to Reuters. Russia says it missed oil deal target due to rise in gas condensate output. The Russians have had a lot of problems the past year since they had the dirty oil come through, and and we have another article. That's a video from CNBC. We'll link to in the show notes as well. But it says Russia can withstand a sharp drop in oil price. Finance minister says, which I don't know why you'd even say that. Like I don't know what's the angle there. But the Russians are struggling. It seems, Ellen. They're not we had the bromance breakup. We had Folly leave Aramco, and now Russia can't get its act together. Can we put the headline out there? This is the end of Russian oil and gas, like a clickbait headline. Energy Week podcast predicts the end of Russian oil and gas industry.
I don't know if it's the end of the.
Too soon.
Yeah, I think it's too soon to predict the end of it. But it's interesting because they're all like gung ho on their and their oil industry. Now they're like we're gonna cut. They were like, oh wait, no. Sorry, here's why we couldn't make it. We produced too much gas con. It's like, stop with the excuses, Russia, already. We know you don't we know you don't care about OPEC and their deal. And it's just,
right.
Enough with the excuses. It's like, I don't know.
So where are they at? We talked, it's been a while, about them positioning with OPEC Plus in that group. Are they still have that strength position with the OPEC Plus and putting pressure on OPEC, do you think? Or
I think they do. I think they run the thing now because OPEC can't agree to anything unless Russia already agrees to it. And now that Folly is gone, I mean, I don't know what the relationship between Prince Abdulaziz and Novak is like, or Putin. I mean, Putin shows up to Saudi Arabia. I mean, like he owns the place practically. I mean, he walks around like he owns everything, but But I do think that this is, and I mean, maybe the fact that they actually gave an excuse this time as to why their production was too high, that shows something. But I don't know.
Well, I didn't know with the dirty oil and now this marker if the OPEC members would kind of frown upon them and give them a little stank eye, if you will. But you don't think that's going to be enough to deter them, huh?
They'll say something, but it's been the same story for like 2 years. I didn't link to this mostly because for some reason I wasn't able to link to any Bloomberg articles. But there's an article in Bloomberg that was basically arguing that Saudi Arabia should just go back to its all-out production, like its NAMI strategy.
Mm-hmm.
That's an interesting idea, but it's like can they handle it? Can Russia handle it? I mean, they're so tied to this OPEC deal now that I don't think that I just don't see that as a realistic possibility right now. But of course, everyone used to criticize that NAMI policy, from here to there. Now suddenly like, oh yeah, we should do that again. Like you all were like, the biggest question was, when is Saudi Arabia going to drop its ridiculous overproduction policy? And I was like, actually, it makes a lot of sense for them.
One thing we should get to before Dr. Foreman comes on is we broke news on here last week, and then we took it back. But we actually broke the news of Rick Perry resigning from the Department of Energy, I feel like. So we should get credit for that. So all the news publications who are talking about credit this podcast.
I think it was Politico that actually claimed to break it. But
they got it from here. And just like we broke news about the drone strike at the Saudi Aramco a few weeks ago. I mean, we actually broke it, and no one credited us that. Let's just recap where this podcast has gone, Ellen. We have another podcast who has tried to steal our name.
Yeah.
And
I don't know what happened to them. Haven't heard from them in a while.
I hadn't either. But and then we have we're not even journalists, and we're breaking news. Should we have Nate reach out to? So here's a question: do you call him former governor or former secretary? Like which?
Or former presidential candidate.
Former candidate.
I think you just call him Rick Perry.
Rick Perry?
Rick Perry of Arabia. Remember that picture of him in the sand?
I bet he has some low-ranking position, like he's like mayor or something, and so you should get him on, like, Mayor Perry, it's good to have you. He would just completely catch him off guard or something like that.
You know what? Rick Perry, if you would like to come on our podcast to discuss anything you want other than the Dallas Cowboys, I will not discuss the Dallas Cowboys on the show. Other than that, we will call you anything you want.
And Freedom Gas.
Yes.
And Freedom Gas. No Freedom Gas.
Yeah.
So. All right, and joining us once again from the API, Dr. Dean Foreman, the chief economist over there. Dr. Foreman, it is October. How is it going? Is it cooled off in D.C.? It's finally cooled off here in Texas. Is it cooled off over there in I would say the great state of D.C., but that's not the proper. So in the District of Columbia.
Hey, Ryan. Hey, Alan. Yes, it has cooled off, and nicely so.
Okay, so we have your monthly statistical report, which will be coming out on Thursday. So just a day or two after the show comes out, you can find that out by going to api.org, the top right, Chief Economist. Click on that, and you can find a link to all of Dr. Foreman's great work. Dr. Foreman, the thing that stood out to me, I usually go to the executive summary, but I scrolled on down to the inventories. Total inventories increased year on year for the 11th consecutive month. That's not good news for prices, I don't think. When might we? I can't make predictions. Is this something that's we should expect again next month, or I don't know how you can word it without making your forecasting, but I think you know what I'm getting at.
Well, it was a really interesting month because we had a record high for the month in terms of demand. We had records in terms of exports, but yet the inventories built up. So this just tells you how strong the production trends have been.
And we're seeing that the rig count is, continuing to fall. I think I saw this morning, was it 120 rigs or something like that throughout the year? And we've put out a couple of things about the ducks, I know, or the alleged ducks or agnostic ducks. I feel on that. But the ducks are theoretically going down. The ducks are leaving the pond. They're flying south for the winter. At some point, this does have to turn over. We cannot. unless there's just a lot more ducks in the pond than we theorized. The ducks are going away. The rigg's going down. The rigs are going down. But what should we be looking for as rigs come off market? A 2 to 3 month time period before you would expect that production to come online and then start to decline? Is that kind of a good rule of thumb for the listeners who are kind of going, okay, well, I'm trying to track all this information, but it's got to turn over at some point?
Well, it's a great question because that timeliness has changed and the short-term deliverability of the industry has gotten shorter and shorter, where if you've got infrastructure in place, it really is days to weeks instead of months as it was a few years ago. Okay. So we really do look for the pulse of change off that slowing rig count to show up sooner. But as you said, with the ducks kind of flying south, it really looks like that with record numbers of those. And keep in mind, back in April, May, the initial estimates from the U.S. Energy Information Administration were that we had 8,800, 8,900 ducks. And those numbers are down toward 8,000, but they're still really close to record levels. This means that if there were no drilling, and keep in mind, drilling is scaled back, but not like catastrophically so, as that continues to go, and there's a lot of backlog inventory of these drilled but uncompleted wells or ducks, that we should expect that plus continued strong productivity trends to result in at least the potential for production growth to sustain through this year despite the slower drilling activity. And that's what we've seen.
Yeah, and so one more quick follow-up on that, and then Ellen, hop in here, please. We covered a story this morning on the Texas Oil and Gas podcast talking about now that we, for so long we had a tight market on pipeline capacity in the Permian. That market is now loosened up. You have spare capacity in the market. How do you guys view something like that? Where you see, okay, we couldn't hardly put it all in the pipes. Now we've got excess pipeline capacity. Should we start to see that sway any of the numbers on the report as we move forward, or will that just kind of flow into, you might see an uptick in production because ducks are coming online, then get better margins on putting in the pipeline now? Is there anything that we can use when we're reading this report as we move forward to how that might impact some of these numbers?
Well, let's keep the crude price differences, or differentials as we like to call them, in mind. And the difference between WTI and Brent has still been $5 and $6 per barrel, compared with Brent to Louisiana Light, which is a coastal crude, is just $1 or $2 a barrel. So that difference is in excess of the pipeline cost of transportation from the coast going back to, say, Cushing, Oklahoma. So that tells you that on the margin, sources are still using things other than just pipeline to move that crude to coast and export it. So as the pipeline capacity continues to be built, and our projection at at API of looking at the basin balance and the expansion of crude oil pipeline capacity was that we would add, by the end of this quarter, 1.5 million barrels per day, fourth quarter to fourth quarter this year versus last. So as that continues to come on stream, and not all of it has yet, and these new pipelines get up to their full capacity, there's the risk, at least, or the potential for that difference between West Texas Intermediate crude oil and Brent crude oil to continue to narrow. That would be the expected market direction, based on the expansion of capacity and the ability to move the crude to the coast more easily for export.
So I really wanted to turn and look at some of the demand points that you raised. I was really interested by the fact that we are finally seeing jet fuel demand calm down. The largest monthly jet fuel decrease for September since 2001. And that date kind of rings a bell for me in terms of why we saw a jet fuel decrease in September of 2001. So maybe you could talk a little bit more about, we've seen that jet fuel was so strong throughout the summer, and now it's really turning around. What's fueling, for lack of a better word, this decrease?
So the downturn on a year-over-year basis or month-over-month basis in both jet fuel and distillates or diesel fuel have been kind of the mysteries, because we're hitting these, again, highest demand for September on record, despite the fact that we have this market weakness now in jet fuel, which we've talked about as a contemporaneous economic indicator, and distillate or diesel fuel, which tends to be somewhat forward-looking because it covers both the industrial sector and what's happening in a lot of freight and transport. So with jet fuel, there normally is, as you get past the summer travel season, some pullback in September compared with, say, August, July. That's typical. But you're right, comparing back to September 2001, where you had the catastrophic event and then a big downturn, it was exceptional based on the survey data that we see. And keep in mind, we survey 90% of industry on a weekly basis, but it looked weak and it dropped considerably compared to what we otherwise have seen in past years. So this is the largest since September 2001 in terms of the percentage change that we've seen down. And it looks like it could be indicative of a broader economic change, but we need to see a trend over a couple of months before we draw that conclusion. Right now, we're flagging that we saw an unusually large downturn in September, and that does coincide with the weakness that we're also seeing on the diesel side.
One question I was wondering, maybe these airlines overbought in the summer because they perhaps expected oil prices to rise later in the year. Maybe they were overbuying when they thought crude prices were low, and now they're kind of dialing back because they've got all this stuff in storage. I don't know, just a thought. Like maybe the high demand that we saw over the summer wasn't actually indicative of transportation needs, but perhaps was just indicative of a buying spree for storage. I don't know. Can you even store jet fuel for that long?
You absolutely can, and you're right. That could be part of the dynamic with the expectations and all the geopolitical things. People may have locked in some of their supply, bought it, stored it just in case.
And so moving to distillate, obviously that's been kind of the story of the summer, was these low demand numbers for distillate. And that's, as you kind of say, it goes into the API distillate economic indicator. Maybe we could look at the chart that you guys have that tracks this and tell us what new elements should we be looking at on this chart of the distillate economic indicator?
So great question. Thanks, Ellen. When we get into the distillate economic indicator, or the DEI as we call it, there's kind of three main factors. There's things that relate to the supply, demand, and inventories of diesel fuel. We look at crude price or crude oil price futures. And we also look at the risk spread and interest rates. And among those three factors, what we've seen over the last couple of months is that we're really consistently this year where the indicator has come down and indicated slowing, but has leveled off the last couple of months. And that's, if we're looking back historically at, say, what happened in 2008 and 9, where we saw this just plowing down month after month, where it went to serious depths in terms of the historical values of this. It was truly indicative of a recession. And what we've seen is that it's gone into this negative territory ever so slightly, and then dipped back and actually rebounded the last 2 months to where it's basically at zero, both on an absolute level basis for the month of September, but also the 3-month average being zero. So it's anemic, but it moved kind of sideways compared to the last month or two, and it hasn't given that screaming indicator saying that the sky is falling. So in that case, we could try to read the tea leaves and say we're somewhat optimistic that it looks like a slowing, not a recession. But I'm hesitant again until we see more of this play out and what happens with trade frictions and everything else to see what it actually reveals. In this case, we can just read it and say it's definitely consistent with historically continued slowing, but wait and see.
Yeah, it's interesting because the seemingly like positive moves on the U.S.-China trade negotiations just didn't really seem to impact the market. Either the market was just looking for something more concrete, or they're just not going to, be excited about anything until they get the real deal. It was kind of interesting to see that news really did not affect the market in a significant way. I did want to talk a little bit perhaps about imports and exports, because I think we're going to hear a lot of new noise about net the U.S. becoming a net exporter of oil, and maybe we need to like break that down for the listeners, and they really understand what that actually means as opposed to what it sounds like it means.
So following up on your first point, Ellen, I was actually surprised the financial markets did respond positively to the announcement of just postponing an escalation in a trade war with China, in the sense that it kind of kicked the proverbial can down the road just a little, but it really wasn't much more than agreeing to postpone ramping up the tariffs on things that would really start to affect consumers through the holiday season. So if the market had already priced in kind of a doomsday scenario, I would say, yes, it would make sense to rally on that basis. But given that, frankly, the market has already priced in a combination, or appears to have priced in a combination of interest rate cuts, strong corporate profits, and is sitting near relatively high levels, it was actually quite surprising that they didn't look at it and say, wow, nothing to see here. So, I actually had that reaction of, wow, why is the market reacting quite the way it is?
Well, it was
now,
Friday, so people might not
be
be paying close attention.
It could be. So on the petroleum exports and imports side, the exports hit records. So these were the highest exports of crude oil and refined products ever for the month of September. We're sitting at or above 8 million barrels per day. That says that if we're really concerned about the global pull for U.S. crude oil and what that might say for global demand for crude oil, despite the economic slowing, and keep in mind that the International Monetary Fund has continued to dial back its projection of growth for the world, that it's had a pretty marginal impact on terms of crude oil growth, and that the U.S. is basically supplying all of that growth on a world scale. So pretty phenomenal year so far. The thing that really changed from month to month in September, though, was on the import side for the U.S., where we saw this drop of like 1 million barrels per day for the United States in terms of the crude oil it was importing. So our API estimates as of August had us importing close to 10 million barrels per day, and that dropped basically to 9. And the combination of the exports continuing to ramp up with that 1 million barrel per day decrease in the imports basically plowed the net imports for the United States below 1 million barrels per day, down to 800,000 barrels per day for September. In terms of the first month, fresh data, when we've looked at the estimates, this is the lowest that we've really seen. And when we can quantify the fact that we're net exporters of an oil equivalent or energy equivalent basis of about 900,000 barrels per day for natural gas, this is where we basically concluded that because we're already as the U.S. an exporter of coal and of natural gas, it's pretty clear, if that estimate holds on the trade side, that the U.S. for the first time in almost 60 or more than 60 years really is a net exporter of total energy. So that's a pretty phenomenal record, and we've cast it as we're looking for confirmation from the U.S. Energy Information Administration, but in more than a half century, this is the first time it appears the U.S. is credibly some call it energy independence. We think that's a misnomer because it really is reliant on these trusted international trade relationships. But it's key because we haven't gone there before in a really long time. So it's something to celebrate meaningfully in terms of the structural change that the energy revolution has meant for this year.
I
for
like
the United
that.
States for this year. Yeah.
That's
Thank
a good way of putting it. It's important. It might not be exactly what you think, but it is still a really important marker that we've reached.
Yes, absolutely.
So I'm
and
curious.
Something to celebrate. We'll see how it holds up.
If I would have told you, let's say 5 years ago, whatever, that the exports would be where they are, the imports would be where they are, would you have also theorized that the inventory levels would be where they are? So I'm saying, based upon how the market shifted, are you still surprised that the inventory numbers are sitting where they are, given all of the import-export data we just went over?
Well, I'd like to say that for the last decade, I've been one of the people from the industry side who's been a proponent that this is a structural change and that it's meant lower for longer in terms of prices. So I've got a history and a record of having put that out. But that being said, I don't think anybody can really put a stake in the ground and say that they foresaw that the productivity in the last couple of years would continue to increase exactly as it has. It has exceeded pretty much everybody's expectations that the amount of running room for continuing to see the productivity increase, the process innovations. And keep in mind, this is a combination of technologies between hydraulic fracturing, 3D imaging, horizontal drilling, that by experimentation was found to work a decade ago. But it's really just now that people are starting meaningfully to understand at a molecular level why it works. So this is why the recovery factor, or the amount of oil and gas that can be recovered as you apply techniques, learn, drill a new well, but see those productivity estimates. And the EIA does, through its drilling productivity report, the amount of new oil and new gas with an incremental well drilled each month in different production areas, the amount that gets recovered. And those trends have just solidly continued to exceed expectations and increase. So it really has been a surprise to the upside, and now inventory's getting close to that 5-year high. That's really helped keep prices and price volatility in check, even as OPEC has continued to have its output be down compared to a year ago.
Yeah, one more thing real quick, Ellen, if you don't mind. On the exports, the news broke over this weekend that the Carlyle Group is getting out of the Port of Corpus Christi business, at least for now. I think they had a $1 billion stake into that. With the export numbers going up, I was kind of surprised. Now, there's a wide range of reasons that they could be getting out, and I have my own theories. But generally speaking, it felt like the export business on the U.S. side of things, building terminals, dredging the channels, that was going to be a very viable business long term, or it'd be worth companies, sinking massive amounts of capital to do these projects. Do we expect these export numbers to continue to at least stay at this level or go up and to the right? Or do you see something like with the Carlyle Group pulling out as maybe an indicator that the export business is not as lucrative long-term as some of us have considered it to be?
Really hard to say and hard to speculate on where that one firm might be coming from on it. If we look at the trend, one of the things that we talked about a few months back is that we're going to start to hit a bottleneck before long on U.S. crude oil exports. The fact that as we're sitting above 3 million barrels per day of exports of crude oil, that the capacity is really 4 to 5 million barrels per day for the U.S. based on market factors, congestion, things like that. So it could be indicative of their particular financial situation. I would say that based on that capacity limitation, there are legitimate challenges in terms of permitting, building, and moving everything forward that have to be addressed. But it should be a viable business in that the productions continue to grow, the demand for it's continued to grow. There's no imminent market sign that you would shift directions off of that. So it looks like a green light from a business perspective. What their particular expectations are could have been different.
Sure. Ellen?
I was going to just ask a little bit. You brought up OPEC, and there have been some grumblings and rumblings about maybe OPEC is going to try to cut its oil production even more. In your perspective, would that just provide more space for U.S. exports to grow, or could it actually help draw down inventories?
It is a question of the day. I would say that, we've been there before. We see what happens each time OPEC does this, and they just cede market share to U.S. firms. And believe me, the U.S. producers will be very thankful if OPEC goes down that road, because it does, in the short term, tend to support prices. But the U.S. has just had this running room for continuing to grow the production. So it probably will advantage the U.S. to continue to increase its exports, its production, and frankly, its market share on a global basis.
Okay, I know we are running up against the clock, Dr. Foreman. We were talking offline, but we will tell the listeners, because of some scheduling conflicts, we are planning on having Dr. Foreman on again next month, but it might just not work out. But we want to get that out there, that if you don't return next month, it's just a scheduling conflict on our end more so than yours. Dr. Foreman, anything that we did not touch on today that you want to make sure that the listeners are aware of, or something to look forward that maybe me and Ellen didn't keen in on when the report comes out on Thursday?
Well, I just want to clarify that the report, because of our timing difference in the interview for this month, we actually put the report out on Friday, so it's currently available on api.org If you go to the chief economist section or the monthly statistical report section, you can find the report directly, and it's all available as of today.
Wow. I mean, Dr. Foreman, I got to say, I'm upset. I thought the deal was we get to break this news to the masses. I didn't know. Well, we scrap that comment. Dr. Foreman may not be on the show anymore. Let's just say that right now. Dr. Foreman, yeah, we need like super secret information. Dr. Foreman, it was wonderful as always. We'll hope to get you back on November, if not December for sure. And we'll try to get you on before the report comes out. We're going to blame Nate for not getting that done on our end. It was great to have you. API.org, you can go get the report out. It's out now. Nate will actually link to that in the show notes. So you can just click the show notes and just click to download it there. Dr. Foreman, thank you so much for your time today.
Thank you both. Great talking with you as usual. Thanks.
And once again, that was Dr. Dean Foreman with the American Petroleum Institute, API.org. Nate will link to all that in the show notes. Ellen, we got another report taken care of. These dang inventories, they will not go down. And it just drives me crazy. It's like, no matter what you say. I mean, if you think about it, if I said, hey, the U.S. will decrease its imports and hit all kind of record exporting, would you think the inventory level would be up for 11 consecutive months?
Yeah, you would think that they would be down, but no. And wasn't it last week that they? Well, you know what? Though last week was there was like a 9 million barrel build, but there was also an SPR release.
Oh, SPR.
So that darn SPR,
Okay. Well, where will you be this week talking about what's important to you?
Let's see. I will be on investing.com, and I'm also going to be in Washington, D.C. later this week speaking at the conference with the other doctor, the fake Dr. Energy.
The fake Dr. Energy. Wow.
Sorry.
Wow.
Sorry. That was not nice. Yeah. I'm speaking at the, what is it called? The National Council on U.S.-Arab Relations. Yeah. It's their annual Arab-U.S. Policymakers Conference, and I'll be speaking about energy.
Surprise.
So
not
by.
Yeah, not New York Giants football or anything like that to be on energy.
This is kind of interesting. I was just looking at the invitation. It says, dress is business attire or military class A SAS national dress. I really want to know what military class A is.
You should go rip like a uniform or something.
Yeah, I'm totally going to show up in it. No, I think that's like against the law.
Yeah, I think it is too. But it's close enough to Halloween. You'd be like, I'm going to a Halloween party afterwards.
There we go.
Okay, investing.com.
Maybe I could show up in my Aramco hard hat. I got an Aramco hard hat.
There you go. No one else. That's street cred right there. No one else would have that. Okay, so investing.com. Forbes, Hill, Bloomberg. Maybe.
Forbes.
Maybe.
I don't know about Bloomberg. I'm supposed to be on Bloomberg TV next Thursday, though, talking about Aramco. So maybe there'll be some interesting news in between now and then.
Okay. You will link to your Twitter account, which they can find out all of your activity on Twitter. Listeners, Texas Long Gas Podcast is where I will be. I will be at the Bush China Foundation next week. We haven't talked offline if we're going to do a show next week because I'll be out of town. I think Ellen's got some travel, so I'm not sure if we'll be back. We got some travel and stuff, so we'll be back at some point, but we got some traveling I can't even speak now, conflicts. And so just be sure to do that. And we created a LinkedIn page, so you can go to our LinkedIn page, and we'll be posting updates and stuff like that on there so you'll know what's going on with the show. Nate will be saying that. Thank you so much for tuning in, and we'll talk to you next week.